If you look at some of the meme coins that are going nuts, the speculation that's going on in a lot of the cryptosphere, it does seem like the floodgates are opening. But the price action on Bitcoin, while a little bit of a pop today, it's not enormous. It's taking us back to levels we were just at 2 days ago. And I would dare say that we're still stuck in this trading range of around 30,500 to 27,000. And the other thing I would say is that leading into the potential default for the U.S. government, this is when Bitcoin needs to shine, right? We saw it shine or start to shine with the banking crisis. The potential for a default should be seeing even more price action to the upside. So these are the things I watch as a technical trader. Is if we're not getting a bigger move later this month in Bitcoin, I would start to get very, very bearish.
Popular technical analysts and chief market strategists at Verified Investing and in themoneystocks.com. Here Solway says he's starting to grow even more concerned and bearish about Bitcoin and the overall market for digital assets, particularly as a result of the hostile regulatory environment in the United States. The cryptocurrency market, in the opinion of most traders and analysts, is still firmly in a bear market, and the little price increases are only bear market rebounds. As he has predicted in past interviews and online broadcasts, Soloway anticipates that Bitcoin will fall to a new record low that will be lower than the bottom of the $15,700 FTX. He has made these doomsday forecasts ever since he first forecasted that Bitcoin would fall to the sub-20 range in late 2021 and early 2022. According to technical analyst Solway, the only time a bear market bottom can be predicted is when everyone has completely lost faith in the cryptocurrency market, and sentiments are at an all-time low. The seasoned trader and expert claims that has not yet occurred in the current cycle for the cryptocurrency market. In a recent interview with Stansberry Research, Solway used the example of the frog-themed meme coin Peep, which saw a 1,500% increase in popularity in just 2 weeks. If there is still so much speculative activity surrounding a meme coin, according to Solway, the crypto market has not yet reached its true bottom for this cycle. The growing regulatory antipathy in the United States is another factor keeping Solway from expressing enthusiastic feelings for the cryptocurrency market. It is obvious that U.S. regulators have a different objective in mind when well-known industry heavyweights, like Coinbase chief executive Brian Armstrong, call on them to provide the sector with some much-needed regulatory clarity, or risk exchanges like his move outside of the country.
Couple different things, right? And you're right. Here's the chart. We have that trend line that I had in last time we discussed it, right at that 30,500 level. We pierced it briefly a couple times and then came right back in. And we've really gone into this sleeper mode. If you go back to, mid-March, we're still sideways in this 27 to 30,000 range. So to me, this is a level that is still reminiscent of a bear market rally. If we get above, like I said last time, above that 30,500 level, we can start to talk about maybe the low was 15.7. But as of now, I don't see that. And I still see speculation. I mean, in trading markets, including commodities and cryptocurrencies and stocks and everything else, bottoms are made when there's massive amounts of fear, and people are very skeptical initially when something takes off. With Bitcoin, it hasn't been like that. We've seen the speculation in Pepe coin and all these other meme coins. It's a casino, and that's not the sign of a bottom. In addition, I look at what's going on with the government regulation. The government's purposely holding back regulation until they launch their CBDC, which then brings into the question of, is Tether even worthwhile anymore? Is USDC, is that even worthwhile if you have a CBDC that's basically fulfilling that job? Right. Does that have an impact on the cryptocurrencies as well? And I think it's important for investors to understand what's really going on here with the U.S. government. The U.S. government is following the Chinese playbook. Now, the Chinese, what did they do? They banned Bitcoin, and they said, okay, let's launch a CBDC, the digital yuan, and they had to ban Bitcoin because they didn't want the competition for the CBDC. They wanted the digital yuan to gain traction and start to be used as a currency, which it is now. It's being intercontinental. We're seeing trade with China being conducted with many countries with the digital yuan, right? So that was their playbook, and now look at what China's doing. China's actually saying, okay, well, now we'll allow people to be involved in Bitcoin again because we have our foothold via the digital yuan. The US isn't about to ban Bitcoin, right? That's not going to happen here. But how are they doing it? They're doing it in a different way. They're not allowing regulation. They're not giving any guidance on regulation. We know, is it a security? Is it not a security? Even Coinbase, right? Coinbase has said, hey, we may have to leave the US. They're suing the SEC to get clarity, and the government's just like, nope, we're not going to give you clarity. So this is the way the U.S. government is handling it until they launch their CBDC. So I'm in the full part now. Until we get a CBDC from the Federal Reserve, I don't think you're going to get regulation in the crypto markets in the United States. I actually have a very bearish outlook for the second half of this year. I'm actually looking at a correction of as much as 20% in the S&P 500. The charts are telling us this too. I mean, if we just look purely at the S&P 500, in fact, let's go right to that chart right now. What we see is a chart that had a big drop following the 2021 highs in in January of 2022. We saw the big drop. We've then seen complacency take hold. And this is really important for investors to understand. This is the way tops are made. You have this euphoria, which we saw in 2021 in all markets, including stocks and cryptocurrencies. You then have a dip, and then you have sideways consolidation. In fact, let me see if you would just let me bring up this chart of the NASDAQ composite. I want to show you this because I think this is a game-changing chart, and I'm going to put two side by side here. So here on one side, let me bring up the NASDAQ as well. We're going to look at the NASDAQ in two charts. All right, we're going to bring up the weekly chart here and the weekly chart here as well. And what I want to do on this weekly chart, going all the way back, we're going to go all the way back to the 2000 market when the dot-com bubble hit. Okay, now what we see here, look at this. This is just, by the way, Danielle, this is the stuff I live for, right? So what we saw was this down move off of the euphoria, right? We all agree that the dot-com bubble was euphoria. We then had the down move, and then look at the pattern that happened before the bigger move down occurred. And then if we go here, we look at the same sort of pattern formation, right? And so my thesis is that this is just the beginning of a bear market that we are entering in. And if we look at what the NASDAQ did, we know, first of all, the NASDAQ didn't make highs for 10 to 15 years. In fact, I think it was even 16 years. I actually think we're in the same position here where we've had so much bloat due to Federal Reserve printing of money that when this starts to drop, we're going to see the NASDAQ not make highs for probably at least 10 years going forward. But again, the mirror images on the charts are scary here in terms of the 2000 period and what we're currently seeing. If you look at, first of all, the cycles, you have a cycle here where we're due for a corrective move. It's been an elongated bull market. If you go back to 2009, it's all due to Federal Reserve printing of money and low interest rate policy, essentially they were just dropping money left and right, free money and printing money. The government was sending out checks. And then you look at what's happening now. Yes, inflation, we saw the CPI data come in a little bit, but it's not going to get back to 2%. It's just, there's too many issues. The first drop from 9.5% to where we are now at 4.9, that's the easy amount. That's the easy drop. That was supply chain. The problem is wages have gone up, and it becomes very sticky. Once those wages go up, it's very hard to get that genie back in the bottle. So you're looking at inflation that probably stays at 3% for multiple years, and that essentially handcuffs the Federal Reserve. The Federal Reserve is going to be very, very careful and wary of printing money or lowering interest rates with inflation, let's say at 3 or 3.5%, because they're going to worry it's going to be a big pop to 15% as the next result. So without printing of money, this market has not been a real market for a long period of time. And when the investing public realizes that the Fed's not going to come to the rescue, that's when you see real panic set in.
But they've come to the rescue of the banks.
Yes, but again, yes, and you're correct on that. But the key is that when you see the rescues for the banks, that's not inflationary, right? They're basically making sure the banks aren't blowing up. They're making sure depositors are made whole, but they're not printing money. In fact, you could argue that what's going on with the banks is actually the banks are tightening credit. The banks are being more careful on lending, which is actually working to tighten monetary policy via the banks. So it's interesting, you're right, that they have come to the rescue of banks, but it's actually worked towards tightening versus loosening policy. Right now, let's call a spade a spade. The retail investor is still in the mindset that the Federal Reserve will come to the rescue. All right, so again, we've been conditioned. It's almost like ringing a bell and the dog comes to the food.
Yeah.
The same thing is true for investors. Investors have been conditioned since 2009 that the Federal Reserve, any sort of big hiccup in the economy, the Fed will come out and print money. And so what we see buy the dip continuing. We see it in crypto, we see it in stocks out there, and that's creating this false sense of security, or what I call complacency. at some point that kind of mindset of the investor will shift dramatically. So again, to me, that's where the market has a lot of issues in the future over the next 6 to 12 months.
What do you think of Gareth Soloway's interview? Do you believe that even though developers and investors seek to other countries for stronger regulatory conditions, regulators would hold off on enacting acceptable laws for the cryptocurrency business until the Fed issues a CBDC? Please share your thoughts and views in the space provided below. Make sure to like this video, subscribe to the channel, and enable post notifications so you don't miss any of our regular uploads. Thank you for watching.